Hey traders, welcome to Charts and Coffee. I don't know if you can hear that. We are broadcasting from a very, very stormy South Florida. It's been rumbling with thunder and lightning all morning long, which actually makes for a great sort of war room day here in the office. And we are going into FOMC, so we're definitely on high alert in terms of volatility and what this could mean going forward. As I mentioned on the 7th, this wasn't calling a bottom. This wasn't a process by which I'm trying to be the first to tell everyone, hey, we're probably bottoming out. This was a process based on macroeconomic understanding in terms of where we are within this overall move. So I'm doing something I don't do very often, although it is part of my overall approach to time frame. I'm looking at 3 time frames: 5-minute, daily, and weekly. Weekly is for position trades, daily is for my swing trades, and 5-minute is for my day trades. Now you'll very seldom see me go out to a monthly. Monthlies are actually really just one of those time frames people like to use when they're trying to make a larger point about overall trends or inflection points, but they're not tradable time frames. So be cautious of anyone spending an inordinate amount of time on a monthly. They're not tradable. When's the last time you looked at a monthly and entered on that? And maybe some of you said, Rog, I do. Great. That's fine. You're in the minority. Most traders look at dailies, maybe weekly. So be cautious about all, monthly analysis, making grand, explainers about what's happening next. They're very unrealistic timeframes. Remember, a monthly time frame is 1 full month of open, high, low, close. Crazy long time frame. Weekly is also really long, but this is where I will go to get a little bit of an understanding of a time horizon that's going to be at least 6 months to hopefully multiple years, depending upon the quality of the trend. So we're starting off with the weekly here. Gang, the weekly has been neutral all year long. That tells you something. The S&P is in a neutral underlying market trend on the weekly. And if you look at that, and let's take a look at the XLK. This is also neutral. XLK is the most important sector in all the markets. And gang, we'll get to the questions, but please listen up because this is going to make a huge difference. I've been spending some time this morning looking at macro reasons that support the conversation we had back on, did I say June the 7th? I meant to say July. It was this month on the 7th. You can find that video over at the Simpler Trading YouTube channel called The Light at the End of the Bottom. And rather than pull out some secret squiggle, I've got plenty of my own to say, well, the secret squiggle is telling us this is a monetary policy event. It's a monetary policy owned macroeconomic cycle. The Federal Reserve right now is hiking rates. We are past the halfway point to the ultimate target rate probability that we're likely to reach by December. This is not guesswork. This is looking at the Fed fund futures, which are actually, somebody asked me the other day, and it was a great question. How accurate, Rog, are Fed fund futures? They're extremely accurate for 2 reasons. One, the Federal Reserve can see by looking at, can you all hear that thunder? It's crazy out there. I'll be honest, I love working and trading on days like this. Although my dog is underneath the desk, hiding out on her floof because this thunder scares the heck out of her. The cat, however, back there doesn't give a rip. All right, so when we think about where we are, we're halfway to the ultimate target rate probability. And a lot of folks ask me about Walmart. We'll cover that as well. I just don't want anybody panicking or relying on some indicator that's crunching open, high, low, close to say, well, we're going higher or going lower. So I will refer to indicators, of course, but they've got to be resting on a sound analysis of where we are macroeconomically. Okay. So, neutral underlying market trend. By the way, is that a secret squiggle? Absolutely. If you're a member here at the Simpler Trading community, in any of the main rooms, I share the absolute best way to understand the underlying market structure. And not just if we're in a bullish or bearish. That's binary, that's amateur hour. You don't want to go there. Bullish, bearish, but Charles Dow over a century ago taught us there are four market behaviors. There are four market trends. Up and down are the one that most traders look at until they realize and they mature as traders. So here, let's shortcut the process, right? There is accumulation, narrow sideways, and there's distribution, wide chop. We're in a distribution market trend. So overbought, oversold does apply. If we're in a neutral market environment, which we are on the, for example, the XLK weekly, and we are, by the way, on the XLK daily, this is not the time to go bring out analysis about how we're going to keep heading lower. There's actually no macroeconomic basis for it. And by the way, I know a lot of folks, including me, are wondering what's going on with Walmart. Gang, I need a separate show eventually. We just call this Salty Raghee. This is how the markets really work show. Not about secret squiggles alone, not about price action alone, but really triangulating macro, price action, and yes, indicators, technicals, and then realizing you really need all three. You know, if you're just going with a secret squiggle, incomplete. If you're just going with price and ignoring macro, again, incomplete. Does Walmart change the narrative? I don't believe it does, not one bit, gang. I really don't. Yes, it's going to be opening down around 120. It hit 119, but we've been here, gang. Ask yourself, are we going anywhere new? Walmart going from 132 to say 119 really isn't a big deal. Let me ask you something. If you've already seen the movie before, are you going to be surprised by the ending any longer? No way. We've seen this movie. We bottomed out around 117.35, and you can see the 200 EMA propulsion sitting at 137. Quite frankly, anything happening in that 20-point range is really relatively uninteresting because we've been back and forth this path before. Does that make sense? So don't look at the move alone. Ask yourself, is this something that we've never seen? Is this a new high, a new low? Is this a shift in the underlying market trend? And it is at the moment. Take a look. Even if we're to open way down there, is this somewhere new? Not at all. So this doesn't shake anything up. What you might want to do if you're looking at Walmart and wondering, what does this mean? You can take a look at XRT, or actually Walmart is weighted within the RTH ETF. How is the RTH moving on this Walmart narrative? It's going to open down at 158. Again, have we been there before? We have. That's going to be right down in this area here. Nothing new. What about the XLP? XLP is going to open at 70, basically 73. XLP doesn't give a rip about what just happened to Walmart. So until you start to see, and this is how we know, you drop a pebble in a pond, now you start to see all the ripples, right? Are we seeing a ripple effect in other places? Barely. So I'm not making Walmart really something that I need to go seek shelter over. It itself has not even put in a new low. If we put in a new low, we'll recalibrate what our analysis is. If anything, this area around 120, 121, I wish we got down to 117, 118. That would have been nice. We could have looked potentially at an aggressive fade, and I would have looked to get long calls if that were the case. All right, so let me show you an image here. And this is from Wall Street Journal. Gang, this is so interesting and just continues to tell me that there is no reason to start panicking people. Gang, if someone's panicking you, if you watch television and someone's panicking you, they've got something to sell you, right? Because panic grabs that part of the brain that says, oh my gosh, what do I do? Hell's a coming, right? I don't see that at all. The idea that the Federal Reserve hiking rates is going to cool inflation, we all know is incorrect. And if you don't, You can take a look at this graph. This is core CPI. This is the inflation that we feel, not the imaginary inflation that the Federal Reserve likes to track in the PCE. This is CPI right next to M2. What is M2? Well, Rog, I think I remember you talking about the 4 pillars of macroeconomics: growth, inflation, money supply. This is money supply, and monetary policy. So this is one of those 4 pillars. By the way, the Fed's not printing as much, and you can see that M2 growth has been dropping over, well, you can see there, look at that cyan or bluish colored line. And as M2 falls, look at CPI. It's got a delayed effect, but when we have less money printing, well, we're going to see less inflation, because part of the reason for inflation is the exorbitant amount of printing we've seen for the past, decade. Does that make sense, gang? This isn't just correlation, which I do not believe in. It's causation. We understand the cause of the CPI dropping as M2 growth, the money printing, the money supply also drops. Really cool graph from the Bureau of Labor Statistics, the Federal Reserve, and I think they posted this in the Wall Street Journal this morning. Really cool chart from BLS and the Federal Reserve. Then you might ask, okay, could that have implications for the US dollar? Let me show you. This is a funny little ETF. ETFs are kind of my thing, sectors and ETFs. This is CEW. This is basically emerging market currencies. All right, I'm going to show you one more weekly chart. We don't do this very often. I'm going to show you one more weekly chart and squeeze in some data. We've been here before, and actually, if you include even more on this weekly, let's go ahead and do that. Let's go back. I think it's maybe 10 years. Yeah. Look at where we are. Okay. Again, this is not a liquid ETF, but it's an interesting group of bonds, longer term treasuries, and sort of an emerging markets currency. Look, not emerging markets as an EEM, which is heavily weighted in China anyways. This is a currency view as far as the dollar, because if we're talking money supply, we're talking dollars, right? How many dollars are being printed? Look at where we're bottoming out. When folks ask, Rog, could the dollar keep heading higher? Yes, it could, but could it start to slow its roll? Yes. And the reason for that is we have the European Central Bank starting to move into their own tightening cycle. And we have that then as sort of a competitive effect on dollar upside. So I would still buy the dip in the dollar, but the kind of acceleration, right? That's the fear that equity markets have. Stonks are freaked out by strong dollar. Well, so I'm sort of trying to show you all the reasons, right? Not just some secret squiggle, leading us to believe in panic, but rather, what is the data telling us about money printing? What is the price action telling us about the reaction to reduced money printing? How could that affect inflation? Could we buy the dollar in a dip? Absolutely. But let's not expect the same kind of upward acceleration that we've seen in the past. So I know a little bit of a kind of departure from our normal conversations here in our charts and coffee, but it's a really important point, because I'm just seeing so much fear mongering out there because, some random secret squiggles telling us we've got this, monster reason to be concerned about more downside. I don't see it in the data. All right. So hope that helps. Now, I saw some earlier questions about XLK. And so in terms of XLK, is it buy the dip? No, I'm not crazy about sell the rip, frankly, either. I'd like to, but although if there is anything to do, it is absolutely overbought XLK, secret squiggle, right? My slow stochastic. Gang, if you don't have a way to understand overbought and oversold and the momentum coming out, the confirmation, if you will, right? When you hear momentum, think confirmation. All right, someone's saying this momentum, what is it confirming? So momentum really equals confirmation. So if I've got an overbought stochastic, right, which is while this is, and we've got the momentum coming back down, that should mean, yes, an overbought market's going to sink back into the range. But we're not in that zone right now. In fact, that zone is really closer to 139. So be cautious if you are tempted to chase this thing lower. please don't chase. We're going to open up around 136 even. We are not in the zone right now at all. All right, next up is Schlumberger. All right, so take a look at Schlumberger. High concentration weighted stock within the OIH. So Schlumberger and Halliburton are really, for the most part, your oil services ETF weighting. Is it in a downtrend? Yes. If we have a downtrend, and again, my members here, community here at Simpler Trading. Let me show you something here. So the Simpler Futures room, the day trading room, the Simpler Options room, as well as, of course, my Sector Secrets Mastery, you all have access to this thing. You want to know what the market structure is? You've got to separate the momentum of the market from the trend of the market, not just, we're binary up or down. This is a downtrend, bearish momentum, bearish trend. This is a sell the rip. Absolutely. So Kevin, double red, absolutely. Below the 200, you got it. Darvis zones overhead. This would be an interesting sell the rip. I'd crack open the OIH and I would make sure that I'm not overlooking other potential setups that may lead me to going with the tide, not an individual boat. I like that boat, though. I like that individual stock, Kevin. Good eye. All I'm going to say is if we crack open OIH and we see a large number of stocks weighted within, the top 6 that are moving lower, you might get more bang for your buck in OIH. But I do like Halliburton to the downside. I do like Schlumberger to the downside. Just be aware of where we are in terms of earnings windows. But other than that, yeah, I love this downtrend. It's a confirmed downtrend where the strategy says, hey, let's short the rip. And we're south of the 200. Love it. Love it. Good stuff. All right, next up, my thoughts on how Walmart's statement may affect the FOMC. Warren, zero. Absolutely positive. Remember, gang, it wasn't but a few months ago where people were running around saying, oh my gosh, Ukraine is going to change the FOMC's mind on things. It's a little painful when I hear things like that because it just tells me that a lot of traders confuse macro by way of headlines to macroeconomics. Gang, when I tell you the Fed doesn't give a rip about headlines, believe me, their actions never map to it. So Walmart is a headline. It's not a macroeconomic factor. I showed you some macroeconomic factors. I do not believe in any way they give a rip about Walmart. And frankly, when you look at the price action, having shown you all the ranges, do you all? I mean, really? And it's okay if you say, Rog, no, that's a move and that catches my attention. That's fine, of course. But we haven't even put in a lower low. If Walmart breaks 117, I'm going to have to recalibrate what I think Walmart's communicating about maybe staples, about maybe retail. But it's one stock that's already in chop, moving down to not even a new low of the chop. So I don't care. And I'm pretty sure Walmart's not keeping the Fed up at night. And again, they've got other things they're focused on. So I hope that makes sense. All right. Okay. Next up, do long calls and long puts provide the greatest leverage available through options, or are there other types of options that provide even greater leverage? Nick, I don't know. I mean, I would have to say there probably are, but leverage is not ever, when I'm putting on a trade, not even the top 3, 4 things running through my mind is, am I leveraged to the hilt on this trade or not? I like long calls, long puts for their simplicity. I like long calls, long puts because I can do that in a cash account, which is what I trade out of. And I think a lot of times when traders get into spreads, they start to put on trades that are actually a little bit more lazy in nature because they have sort of the teddy bear, the comfort, the security blanket of, well, I collected some credit on this trade. It offsets some cost. I think it sets them down a really bad path. So I'm sure there are, but I just really, frankly, I don't concern myself with it because, ultimately long calls, long puts take care of what I need to. The risk is easy to define. The trades are easy to put on. And I just like the nature of being able to trade out of a cash account. Next, and also it keeps us true to our budget because spreads open the door to trading things that we normally may not have the budget for. And this is where I think a lot of traders, especially small account minded or small account traders, right? They're trying to grow an account. They're in that growth mindset. They start swinging for the fences with those spreads. It never goes anywhere well. I've never seen anyone with a small account putting on spreads, over leveraging, actually do anything but gut their account. So that's another reason I shy away from that. And I thank you for the question. What are my thoughts on Lilly? Buy the dip. It's a fantastic look. This is how easy the uptrends are. If you can look at a traffic light, you can either look at the trade flags, which I give away for free to our members, or our multi-trend, which I give to our Sector Secrets folks or anyone who's taken any of my recent classes. Look, that's an uptrend. Green grab candles, upward sloping wave. This is buy the dip. Now, to talk about it now, I'll tell you, frankly, this is really after we've already made two really nice dips. I would wait for another dip. It is definitely a very nice uptrend within the context of what is a very choppy XLV. Gang, I would be very cautious jumping into XLV. It's been choppy for a very long time, right? This is the year. Most of this year has been spent in chop. So what I would do is I would forego XLV. And if you want to find relative outperformance to the up or downside, there are some downside relative outperformance stocks in XLV as well. Things that are moving lower like MDT. Contrast that with things that are moving higher like Lilly. These are both top 11 names within XLV. So I would forego XLV itself, focus on, do I want to be a buyer or a seller? Right now, I would largely want to be bearish because, well, XLV is heading up towards an overbought zone. So for overbought and toppy, then I'd rather focus on things going to the downside. Once we get down to, say, 125 and change, then I'll flip and say, okay, XLV could be oversold, finding support. Now let me go focus on something like Lilly. But Lilly should be fine. It's been defying, the pull of the XLV. Just wait for a dip. Again, into the wave. It makes it very, very simple. Start with market structure. Acknowledge that you're in a stock that is not necessarily moving with the broader sector, and then go from there. All right. So I hope that makes sense. And I will see you all tomorrow. Same time, same station. Thank you as always for joining me for charts and coffee. Gang, please take to heart what I was explaining in the beginning of the show. Really, really important right now. Okay. All right, if you have any questions, as always, feel free to leave them in the comments below. I know some of that stuff I covered the first 12, 13 minutes or so might be new to you all. Leave your questions, leave your comments, whatever feedback you have. I do read it every day. Thanks for smashing the like button, and I will see you tomorrow. Same time, same station. Be good to each other.